Okay, let me just set up the screen right quick and then we can begin. Right. All right. Okay. How are you guys doing? Good. Glad to hear it. All right. So, how are you guys finding depreciation so far? Honestly. It's okay. Yourself, how are you finding depreciation? It's fine. Okay. No, that's good to hear. It's good to hear. Okay. Right. So what I want us to do today, I just want us to do the homework that I gave you. So you yesterday online, right? So I just want us to do 3.9 together and to do 3.10, and then we'll call it for the day. All right. So if we can open up to 3.9, and we'll get into that. See, I have some people online. Is this Etienne? Nah, okay, cool. All right, no problem. Okay, so if you have any questions to my students online, please just switch on your mic. Otherwise, there's a good chance I won't hear you. Okay, so 3.9, go to the reply. And I'm sure you guys will begin to see that a lot of these questions are being raised. Okay. Show the following accounts in the books for the financial year ended 31 August 2008. Okay, so they want us to do the vehicles, accumulate depreciation, right, for vehicles, and then asset disposal. This is the type of question that they could ask you in your assignment or the test. Because you see, they only ask 3 accounts. And here they didn't say whether it's in the general journal or in the general ledger. Okay. All right. But when I look at the answers, I think they're focusing on the general ledger there. Okay. This is the type of question that they could ask. Anyway, going on, it says, Sovena traders had the following balances in their books on 1 September 2007. Okay, vehicles 700,000, accumulated depreciation on vehicles 140,000. Right. Then it goes on to say during the year ended 31 August 2008, the following transactions took place pertaining to the vehicles. On 28 February, a new vehicle was bought for 231,000 cash. On 1 June 2008, an old vehicle which had been bought on 1 December 2005 for 280,000 was sold on credit for 157,500. All right. So Vina traders depreciate all their vehicles at a rate of 20% per annum according to the reducing balance method. Okay. So I've been doing quite a bit of the reducing balance method, which is good.
So is reducing balance and diminishing balance here?
Same thing. Same thing. Okay. So first thing that we want to do is to build our timeline so we can see what the hell is going on. What do we need to do? Okay. So we know that we're doing this for 31 August 2008. Okay. So and this time I said, you know what, I'm going to, now I think we're now a little more accustomed to what we need to do in our books. So I wanted to take more time in terms of building our timelines, right? Because the timeline is very, very important, because if you get that wrong, you get your calculations wrong. If you get your calculations wrong, you might post to the right accounts on the right sides, but then chances are, you know, things might not be all too good. So here they said 31 August. Okay, and what year was that? We're doing this for 2008. Okay, no problem. Cool. So the financial year is beginning on 1 September. Okay, 2007. Okay, and 7. Okay, right. And then they tell us, okay, so there we can begin. We can just do this. Draw this line. Let's imagine it is straight. Okay, and then we know that on 1 September 2007, they give us those balances. Okay, so I'm just going to put a V here for vehicles. Maybe let me go VEH. Okay, for vehicles. And how much was that? 700,000. Okay. Okay. So just in the interest of not having to draw the whole thing, I'm just going to put 700K. Okay. 700,000. Otherwise, I'll be doing this forever. Okay. Then we know that the accumulated depreciation also on the 1st of September was 140,000. Okay, so we've got 140K there. Okay, so we've dealt with what has happened on the 1st of September, or the important information on the 1st of September. Then we go on further. It says during the year ended 31 August 2008, the following transactions took place pertaining to the vehicles. On 28 February 2008, so that's further down the line somewhere here. I'm just going to plug it over here. All right, so 28 February, and that's 2008. Okay. A new vehicle was bought for 231,000. So 231K. Okay. And what I would do here is I would just label this as new, but I'm just going to put an N there because I can see it's already getting very messy very quickly. Okay. So just write new so that you know that that's when we bought the new vehicle. You can even say new and then put in brackets bought. Okay. All right. Okay. Then what else happened? It says on the next bullet point, it says on 1 June 2008, an old vehicle which had been bought on 1 December 2005 for 280,000 was sold on credit for 157,000. So that was 1 June. Okay, so let's do that. 1 June, so that's 6 and that's 2008. So here we sold. Okay, and that was for how much again? How much did they say we sold it for? Okay, 157, 500,000. Do we have our figures correct? Yep, I think everything is good there. Okay. Now, they said show the following accounts in the books of for the financial year end 31 August. Okay. So fortunately, we're not doing anything for 1st of September. So all we're concerned about is showing the year end books at this point where I'm putting this star. Okay. Right. So we need to record everything that has happened over here. Can you see this is now a disposal at midpoint in the financial year? Okay. It's now a disposal at midpoint. So it just makes it a little bit, and also a purchase during the course of the year. Okay. So it just gives us an extra step. Now I want you guys to, remember I made you take a picture of also that second slide when you do an asset disposal. Okay, and I'm going to show it just in case maybe you weren't a part of the WhatsApp group, whatever other reason. Let's see here. We have this here. Okay, that's fine. Let me just look for it. Come in, come in. This is accounting, huh? Okay, and that's learning unit 3. Okay. Right, so this is the slide that I'm talking about right here. Remember, this is the first one. 4 steps for asset disposal. Okay. Then here, if you have an asset disposal midway into your financial year. So I'm going to make that bigger for you guys. Just give me a second. Okay, now you can take a picture. I think that'll be clearer for you. Okay. Okay. So I'm going to show you, I'm going to speak to this, and I'm going to show you where the difference is between that first set of slides and this slide. Okay. So with this slide, you'll see that you have 2A and 2B. Remember, your process is, first we need to remove the cost price of the asset that we're disposing of, right? Then the second step is to remove the accumulated depreciation on that asset that we're disposing of. Now you see, if we're selling an asset in the middle of the year or any time during the financial year, it becomes a problem for us because we always do depreciation at the end of the financial year. So whatever depreciation we incurred on that asset, we would have calculated at the end of the financial year and included in our depreciation and then removed it out of the books. Does that make sense? So now, if we're selling an asset, you are selling an asset 1 June. So that's just 2 months before our financial year. Okay. So now, what we have to do with 2A is we actually have to first calculate the depreciation on that asset, all right, that we're disposing of at 1 June. Then we need to, after we've done the calculation, we then now need to include that into our books and then remove that. So 2B is now us going back to the same process of now removing the accumulated depreciation after having first calculated and included in our books. Does that make sense? Okay. So this is the only additional step. Because it's at midpoint and on the end of the year, we first have to calculate the depreciation on that asset, include it in our books, and then we go on to actually remove all the accumulated depreciation. So that's the only difference. Everything else is the same. Okay. Right. Actually, let me just continue to have that there. Oh, actually, I can't. Oh, I can. Okay, that's fine. Right. So we're here. Okay. Now we need to start doing our calculations. Okay. So the first thing that we need to do is we need to calculate depreciation on the new asset. I think that's the easiest way to go. Okay. So I think maybe let me try to do this in different colors. So actually, okay, yeah, no, it's fine. Depreciation on the new. Actually, forget about this. Let me go back to writing. That's going to be faster. Okay, so new vehicle. Okay, so we know that the value of the vehicle is how much? 231,000. Okay, and since it's a new vehicle, we don't have any depreciation on the asset thus far. Okay, so we know we're not going to actually minus any past depreciation, right? So we can immediately say times the depreciation rate, which we know is what, 20%, right? Yes, we have to apportion it. And then times, is it 6 months? Because it's what? This is, yeah, this is end of February. So we're saying March, April, May, June, July, August. So 100% there, 6 months. So 6 over 12. Let's make that bigger, clearer for you guys to see. Okay, so what do we get? Okay, so we have our depreciation on the new asset, but that's all the way up until 31 August. We know we're going to need this information at some point, so we might as well just get it done. Then we have the old asset that we sold, right? We need to calculate depreciation on that. But here's the thing. We bought this thing in 2005, in December, I think it was, 1st of December, right? Can you see? They didn't tell us the accumulated depreciation on that old asset that we sold. So we now have to calculate that. Okay? We now have to calculate that. But in order to do that, the safest thing that you want to do for yourself is to build another timeline, but now strictly for this asset. Okay? So let's do that. Let's do that. So we bought this 1 December 2005, right? And what was the value of the vehicle? 280,000. Okay, cool. And then we know our next financial year would be 31 August 2006. And the next one would be 31 August 2007. And then the next one would be when we sold it, which is 1 June 2008. So that would be the end of the, because remember, we don't have this asset until the end of the financial year. Okay, so 1 June, give the handwriting there, 8. Okay, so can you see the depreciation we have to calculate for 4 periods here? No, 3, sorry, 3. And this right here. Okay. Okay, now can you see why it's so important to do the timelines? So I'm just going to say 1, 2, and 3. And now we have to quickly check how many months is each of these. So let me just do that in a different color. So that, yeah, that's 9. So December, and then obviously all the way until the end of August. So that's 9. This is then 12. So that's a full year. Okay. And then here to here, that is how many? So September, October, November, December, 4 months. And then January, February, March, April, May. All right, we're ending on May because remember, we're not including June because it's the 1st of June. Okay? So that's 9 months. Want to quickly verify that with me? Let's make sure that we do this right. So again, we're saying September, October, November, December. All right? And then January, February, March, April, May. All right. Cool. So now we can begin to do our calculations. And I'm going to go back to, we're doing activity 3.9. Yeah. Yeah, that would help. Let's complete our timeline. So we sold it for, how much did we sell it for? 100 and? Uh-huh. 500. A good idea right there. Okay, and that was the selling price. I'm going to put SP. Okay, cool, no problem. So let's do this. Okay. My guys online, are you good? Are we still okay over there? Okay. Nothing in the chat, so I assume so. Okay, now we can begin to calculate. So for 1, I want to just increase the font over here. Okay, so for this one, we're saying 9 months, so 9 over 12. Okay, and you guys, you know, you can throw in these numbers in any order, it's fine. And then we're saying 0.20, that's the depreciation rate. And then we're saying, can you guys clearly see, should I increase the font? Is that fine? Okay. Then we're saying times 280K. Okay, so what do we get for that first period? That's 42,000. Okay, cool. Then the second period, we know it's a full on year, so that's 12 over 12, which is 1. Just writing it out for your benefit. Okay, times 20%. Oh, but before we go there, we first need to get the carrying value. My bad, sorry. So 200. Okay, I'm just gonna write it out so we all have that there. Okay, so, and you can even just go straight to then 12 divided by 12 times 0.20. And what did you guys get? 47,600. And for the final period, we're saying there's 280,000 minus 42,000, and then minus again 47,600. Okay, and then this is for a period of 9 months. So 9 divided by 12 times our depreciation rate of 0.20. And what did we get there? 28,560. Okay. Okay, can you see how things flow once you have your timeline in order there? Okay. Awesome stuff. Everybody happy so far? So then the next step is, now that we have all the accumulated depreciation, we might as well quickly also calculate, because we know at some point during our asset disposal process, we're also going to calculate whether we made a profit or a loss. So we might as well also just quickly calculate the carrying value. Okay? And we know carrying value is your cost of the asset to us minus the accumulated depreciation that we've had on the asset the whole time we've had it. And that's how we get our carrying value. So, so let me just quickly write that out. Cost. So when you guys are following the video, you know exactly what we are doing. Get our carrying value. All right, so the cost was 280K. And now the depreciation that we had 42. Does someone have the total on all that? No, not the total carrying value, the total accumulated depreciation. Can someone quickly add the 42 plus the 47 plus the 28? Okay. 118, 560. 160. 160. Okay. Right. So then the carrying value is how much, guys? 161. 840. Okie dokie. Okay, awesome. We're on track. Sorry, say that again. Yeah, we can actually calculate whether we made a profit or loss here and now. Okay. Remember again, how do we do that? We say the selling price, SP, selling price we sold it for, or what we disposed it for, because sometimes you're not selling, minus your carrying value will then give you whether you made a profit or a loss. So in this case, we said we sold it for 157, 500, huh? And then minus the carrying value, which we just calculated, 161, 840. So can you already see we made a loss? What was our loss? 4340. Okay, thank you so much. All right. Okay, I'm just going to put that in negative so we know that this is a loss. Put it in red as well. Okay. Right. So we've calculated everything pertaining to the asset we just disposed of. Okay. We calculated the depreciation relating to our new asset. We did that over there. Okay. We calculated the depreciation and also the carrying value. All right. And also whether we made a profit or loss on the asset that we disposed of. Okay. Now, because we're doing the financials until 31 August 2008, we know that we also have vehicles, because can you see that? 700,000. So it's greater than, significantly greater than the 280K. So that means that we also had assets prior to this new asset. All right, vehicles, should I say? Let me say vehicles. We also had vehicles, all right, outside of the new asset and outside of the asset that we sold. So we need to calculate depreciation on those assets as well, or those vehicles, why don't you say that? On those vehicles as well, okay? So we can label this as the old vehicles, okay? So let's do that here, okay? Yes.
What's like the previous vehicles you have? Didn't you subtract the vehicle that you sold from the 7,000? You do that for every aspect. You can take away the accumulated.
Yeah, you have to take away. But we're going to do that now together. So you guys are jumping the gun, but it's okay. Okay, so here we are. So old vehicles. Now, the reason why I'm just doing all the calculations now is so that when we get into the books, we don't have to be like, oh, but we still need to go and calculate that amount. We still need to go and, so then you have that back and forth between your timeline and your entries into your accounting books. Okay, so old vehicles, we know that this 700,000, because can you see where the timeline is? It's over here. It's before we sold this asset. All right. So we know that, okay, cool. It's inclusive of the asset we sold. Okay. So we then have to say, and this is what you gentlemen were talking about. We then have to say the 700,000 minus the 280K. Okay. That's now how we get the cost of the old assets that we still have at 31 August 2008. Does that make sense? Everybody with me there? Okay. Then we know that we're on the reducing balance method. Okay. So we know that we take our cost and we have to minus it from the accumulated depreciation that we've had thus far. Okay. So when we look at 1 September 2007, we know that the accumulated depreciation was 140K. But again, this accumulated depreciation is inclusive of the accumulated depreciation that we on the vehicle that we sold. Okay. So then we have to say, okay, cool. We're going to say 140,000 minus the accumulated depreciation that we've had on this asset that we sold up until 1st of September 2007. So then we go and we say, what was the accumulated depreciation that we had on that asset that we sold up until this point right here? Oh, okay, I'm back to regular writing. So let me do that in blue. Up until this point over here. Okay. So that obviously is then going to be our first depreciation calculation plus our second depreciation calculation. Okay. And so that 42,000 plus the 47,600. So we come back here. Now I can go back to my things. So, okay, quickly just add that for me. 42,000 plus 40. How much is it? 89,600. Thank you very much, sir. Okay, all right. Okay. Now we have our carrying value on the old assets. On the old assets. Oh, goodness. Sorry about that, guys. Put this on silent. Okay. Right. So what is the carrying value on our old assets? Three, 6, 9, 600. Okay. So let me just do this in a separate line. Okay, so 3, 6, 9, 600. And then now we're saying times our depreciation rate. Okay. And that gives us how much? What do we get? 73,920. Okay. Cool. So now we've calculated the depreciation on all our assets. All right. We've also calculated all the figures pertaining to the asset that we are disposing of. We've also calculated the depreciation on the new asset. Now we can jump into our books. Okay. And you'll see the process is a whole lot more easier once we have done that. Okay. So here we go into the vehicles account and we know, okay, in our steps, the first thing that we need to do is we need to remove. In fact, let's not deal with the asset disposal first. Let's deal with the easy bit. We know that we bought an asset on the 28th of February. Okay, so we can quickly just debit that. So here, what did we buy that for cash? So we say bank, and that was for how much? That was for 231K, 231,000. Okay, dealt with that. Then we know that we also disposed of an asset. All right, step number one, we know it's remove the cost price. Okay, so we're going to credit the vehicles account. Okay, and we know that we use asset disposal for that. And this is how we're really testing you guys, because we're saying the fact that we're actually making you just do the books for a few accounts is actually harder than if we had given you the whole process where you have to follow all the steps. Okay, because now you have to think to say, okay, what happened in the vehicle? You can't use the double entry to kind of assist you. Right, we've dealt with the vehicles account. Okay, then we move on to accumulated depreciation. What's happening in the accumulated depreciation account? We know that in relation to our asset disposal, we have to remove the accumulated depreciation of the vehicle that we just sold. So we know accumulated depreciation what? Increases on the credit side because it's a negative asset. Okay? But removing this accumulated depreciation means we're going to have to debit it. We're going to have to reduce it. Okay? So we come here, and again, that's happening in the asset disposal account, or asset disposal is the contra account. Okay. So here, what was the accumulated? We calculated this to be 118,000, I think, something, 600, 160. Whoa, wait. No, the accumulated depreciation. Aha, oh, okay. Now I get you. All right, thank you so much for that. All right, so all of the depreciation on this asset, yes, 118, 160. I was thinking you were saying 160,000. Like, oh, that's very different. Okay, thank you for that. All right, so we've removed that accumulated depreciation, but at the same time, remember what I told you? Since we are over here, right, no, sorry, I want to go to this timeline. Can you see we sold this asset on 1 June? Okay, so since it was on 1 June, it was before year end. So we have that depreciation that took place before that we have to actually put into our books. Because remember, whenever we have depreciation, we debit the depreciation account and we credit accumulated depreciation. Okay? So at 1 June, when we sold this asset, we need to include the depreciation that took place on it. Okay? In the accumulated depreciation account. So we come here, okay, and we say depreciation because that's a contra account. Okay? And we say how much was the depreciation for that one period? 8560. 28,560. Awesome stuff. Thank you, sir. Right. Cool. Right. Then here on the 31st, we're now at year end. Okay. We know that we have depreciation on one, the new asset that we bought on 28th February, right? The depreciation that took place on that asset. Then we also have the depreciation on the old vehicle, all right, which we calculated. So we need to add these two together. Okay. So we then say, you can even do it inside the account. So you can just actually say dip. Okay, and here we have, what was that? We calculated 70. Let's do this so I can see both. Okay, so 21 or 23, sorry, 100 plus 73, 920. Okay. And what does that give us? What do we get? 020. Okay. Right, so that's your accumulated depreciation account. Okay. And then we have the asset disposal account. Okay, guys, just give me 2 minutes just to finish this, and I'll give you your break, because I want us, when we get back, to just go on to 2.3.10. Or do you want a break? Because we can finish it. Okay, so now this is where now you need to recall your asset disposal process, where you say step number 1 is what? What do we need to do in step number 1? That's step number 2. No. Step number 1, somebody knows. Cost of the asset, okay? The cost of the vehicle we sold. So we know that we're crediting the vehicles account to remove that cost. So here, what are we doing? We're debiting. So here, have your vehicle. Vehicles or vehicle, and that was for 280K. Okay, so this is why your process needs to be in your head. Then step number 2, we said now we're removing the accumulated depreciation. And that means we're debiting accumulated depreciation. So here we're crediting accumulated depreciation. Oh no, not what I'm trying to do. So that was, how much was the accumulated depreciation? It was 118, right? 160, yes. 160. Okay, we've done that. Then step number 2 is recording the actual disposal of the asset. So how did we sell this asset? Well, on credit, right? So what does that mean? We now have a debtor, okay? Fortunately, in this question, I believe it said ignore that. Did it? Or did it not even say anything? Okay, it said ignore that, okay? So we're not going to say debtors and VAT. We're just going to say debtors control. So debtors control is obviously going to increase, so that means we're going to debit debtors control, and that means we're crediting asset disposal. So here, debtors control. Again, your alternative is you can look at the slides to say, what am I debiting, what am I crediting? Okay, but I want you guys at that level where it's, you can think about it in your heads, because obviously you won't have that picture or image when you guys are in the test or exam. So how much did we sell this asset for? 500. Okay, right. Then the next question that we're asking ourselves is the 4th step, final step. Did we make a profit or a loss on this asset? We made a loss, okay? So what are we crediting, what are we debiting? If he was here, I would be on their case about answering. Because I know I spoke to them about this. Are you sure? Because remember we're at step 4, it's about the profit or loss. You're on step 3, right? You? Okay, and 100%. And now, why are we doing that? So I like the way you think. Okay, he quickly saw that. Remember what I told you guys yesterday? The debit and the credit need to balance. Okay, so you could already see that this is less than the 280. So obviously the entry needs to happen over here. Okay. But another way to also think about it is this, and this is what I told the guys this week. Group 3. When we make a loss, I might have mentioned it yesterday. When we make a loss, is that an expense or an income to us? Are we losing money or gaining money? We're losing money. Okay. So since we're losing money, that means loss on the sale of vehicles is going to be debited because it's an expense. Does that make sense? All right. Money is leaving us. That means if we're debiting the expense, then in the asset disposal account we have to credit it. Does that make sense? And also, if we had made a profit, whenever you make a profit, that's money coming in. We are richer for it. Does that make sense? So in that case, we know that our incomes, whenever we realize an income, we credit that income account. So if we were crediting profit on sale of vehicle, assuming we made a profit, then that means that we'd be debiting asset disposal. Does that make sense? Okay, that's a quick way to just get you there. Okay, so here we're saying loss on sale, and here you can just quickly say, and that we calculate to be 4,000. How much? 4340. 4340. Happiness. Any questions? Everything made sense? We're all good? Okay. All right. Nothing from online people? Okay. Right.